A deal can look perfectly on paper. The model can be clean, the sponsor can be experienced, and the deal can still be funding its returns out of borrowed time. That situation has a name and it's called negative leverage. Negative leverage is what happens when the going in cap rate or stabilized yield on cost of the property is lower than the interest rate on the loan. In plain language, the asset earns less than the borrowed capital costs. That relationship was rare for most of the past decade. However, it has flipped since the early 2020s. And the deals coming to market at that time and even today are acquired with negative leverage on day one. Here is why it matters. When the cost of debt exceeds the yield of the asset, every dollar of borrowed capital extracts cash flow from the deal rather than adding to it. That shortfall has to come from somewhere. Either aggressive rent growth closes the gap, or expense compression, or a refinance into cheaper debt in a couple years, or reserves absorb the early drag. That is not automatically a bad deal. Sophisticated sponsors take on negative leverage when they have strong conviction that rent growth will close the gap quickly, as was happening in 2020, 2021, 2022. But here's the question most LPs do not ask. How long does negative leverage persist before the deal crosses into positive territory? In a strong rent growth environment, maybe 18 to 24 months. In a softer market, 36 months or longer, or it may not happen at all under the original timeline. While the deal sits in negative leverage, three things happen at once. Cash flow is thinner than the model suggests, reserves burn faster than projected, and the refinance assumption gets harder and harder to hit. So when you see negative leverage in a deal, three questions are worth asking. What is the going in cap rate and what is the current debt cost? You want the actual day one spread, not a stabilized cap rate compared to a forward rate. How long does negative leverage persist in the underwriting before it crosses over to positive territory? And which specific rent growth or expense assumption is doing the work to make it cross over? If that one assumption breaks, what happens to distributions, reserves, and the business plan? These questions are not adversarial. They are how you separate a sponsor with conviction from a sponsor with hope. Negative leverage is not a deal killer, but it is a signal, and your job as the investor is to decide whether the exchange holds when conditions move against the sponsor. If this was useful, subscribe and leave a comment with a question you would add to that list. If you are reviewing a deal and want a second set of eyes, send me a direct message.